Moody's downgraded the debt a week ago. Inflationary fears are still being discussed in the very biased mainstream media, and Trump announces tariffs on Friday before the New York Stock Exchange opening bell. So is this just a dead cat bounce or something else going on? Well, let's open up our minds and let's get a plan together. So here we have the Wall Street Journal discussing Moody's downgrade to the U.S. credit rating from AAA to AA1 status due to large deficits, $37 trillion in debt, and rising interest rate costs or interest costs. Now, is this important? Yeah, I mean, we also had similar cuts by the Fitch ratings in 2023, and then once again we had the S&P global ratings in 2011 do the same thing. The S&P 500 surged 5.3%, the Dow gained 3.4%, and the Nasdaq Composite jumped 7.2%. Technology stocks also had a strong week. Shares of Nvidia gained about 16%, while Meta advanced 8%. Shares of Apple climbed to 6%, while Microsoft popped 3%. So all in all, pretty good stuff. Oh, yeah, and there's this. Bitcoin hit all-time highs. We were discussing back when we were testing the yearly opening range that testing from above the yearly opening range, as long as this area held as support and we didn't see any major declines or candles closing back under the yearly opening range with continuation on daily closures heading lower, then we would have to be positioning ourselves bullish, as this line in the sand, if you will, is the exact spot that basically gives you your yearly trend and tells you which direction the trend is potentially going to go. And since we based above the line, that is more bullish than bearish. If we would have based, say, traded up to it, rejected, and then based under the line, then we would have been a little bit more concerned. Even if we would have gotten just a candle close below it, we would have been more concerned. I'm going to be honest with you, it was not easy to position yourself for a bullish trade in this area. As you can see, many wicks that popped below that level, but just watching the level for all of these days would have given you at least a couple opportunities to potentially position yourself to catch any rally that you may get in the year of 2025. But looking over here at all of this price action, that probably had you very bearish right here. Because if we fib that range from year high to year low, like so, up here, right above the yearly opening range, you can see there's a major Fibonacci retracement level up there, the 0.618% retracement. Now, I understand that in any other circumstance, this would be considered a dead cat bounce, and this is why you essentially posted up like this, because you had sellers trying to sell this level, you had buyers trying to buy this level. If there's more demand at the yearly opening, then we would expect price to start to trend away from the level in the upward direction. If there were more supply at this level, then we would expect price to trend down, start to show us continuation lower below the level. That would have been the signal for you to be a bear. If we go over here to the weekly time frame, we throw up our moving averages over here, and you're going to see that for us on this channel, we generally want to see at least 1 to 2 weeks closing above the 21 for us to change our longer term bias. As long as you're below this level, then we have a bearish bias, but we can start to become bullish once we get closures above the 21 on a weekly time frame, as this would set our longer term trend bias. This is where we would start to become more bullish on the daily as well. We do the same thing. So on the daily, right over in here is when we first started to become bullishly biased or looking for bullish intraday scalps, with the caveat that we are extremely weak on the year. We are in a potential bear market and all of this stuff. So the daily is naturally going to cross back above the 21 exponential much quicker than the weekly will. It gives us the ability to potentially catch a trend reversal if Bitcoin's price is in fact going to retrace into a dead cat bounce. But this level here is ultimately the line in the sand that changes our yearly bias. As long as we're trading and closing dailies above and weeklies above the 2025 yearly opening range, then we have a bullish bias on the year trend. So this is how you use indicators and objective levels to get a good trend analysis. It's just a way to put a little bit of objectivity into your decision-making process. You need to know how to come up with a bias yourself. In this channel, we have done a very good job of basically saying the same things over and over and over again, not to beat them into your head, just to kind of show you that we do things that consistently work. I never have to go onto somebody else's channel or somebody else's feed to get my bias. This is why it is a fair market, because where my bias may change from bearish to bullish, you may still be very bearish based on market internal data or indicators yourself. And that's okay. Just because I have a bullish bias does not always mean that price is going to go up, especially on a day-to-day basis. And trying to position yourself on a day-to-day basis, it is the hardest thing to do successfully. It's much easier to take a long-term approach to investing. We had the bullish bias. We've had a bullish bias. So last week I didn't put out a video because we had a bullish bias and it was consolidating. And then it finally broke out, right? It finally broke out and we got a nice move to the upside this week, making fresh all-time highs. So let's go look at the S&P 500 real quick, and then we'll go focus on the ratios real fast. So here's the S&P 500. We have tested the 21 exponential moving average on a daily time frame. Let me go over to my other chart so that way I can give you your weekly expected move. So here is going to be the weekly expected move going forward on this week. We do have a holiday this Monday, being Memorial Day, so I'm pretty sure the markets are going to be closed on Monday. Your expected range high is going to be 59.29. Your expected range low is going to be 56.75. We have a 127 point expected move. For any of you that are new, that simply means that we are expecting price to move from this blue line, which is where we closed yesterday, up 127 points or down 127 points. If you look last week, we were watching to see if we built in support here at the bottom edge of the expected weekly move. We did not. We did in fact break back down, and then the next day on Friday we gapped lower. The reason we gapped lower was based on a tweet that came out from Donald Trump, and that was right here at 7:45 a.m. U.S. President Trump posts, "Our discussions with the EU are going nowhere. Therefore, I am recommending a straight 50% tariff on the European Union starting June 1st. Now, obviously, that is going to cause the markets to freak out. And if you look right here at the 7 o'clock candle, you can see that the markets did, in fact, freak out. This is the XLE versus the IEF. Whenever inflationary fears accelerate, you can see that this likes to go up. Now, it has been trading in a range for, I'd say, 4 or 5 years at this point. This is when inflation spiked up to 9.2%. So naturally, investors were positioning themselves for higher inflation. Once again, you can see that they've been talking about inflationary fears ever since Donald Trump announced tariffs. That has been the basic driving factor of inflationary fears from the biased media. But we can clearly see that if it's going down for the whole month of April and then close on the lows, this month all we've done is tested the midpoint of this candle and have retraced. So this candle is essentially testing its own monthly midpoint right now. Whether it goes up or down, we won't know. As time progresses on into the future, we will see what they are doing. I don't look at this on a day-to-day basis. I look at it on a week-to-week basis. If we look at this is another ratio that we can see when we know when inflation absolutely accelerated, and so did this. So this is people positioning for inflation. If inflation is coming and people are afraid of inflation, then we look for this ratio to go up. If we come over here to where we currently are, you can see that this has actually been trending lower. Here is the inflation rate. We got fresh 4-year lows on the last CPI we got, and then you've gotten downside continuation all year on your inflationary prints. So this is when 2025 happened, and every CPI print that we've gotten this year has been trending lower. So here's January 2025. Trump takes in office. We get a spike in February on the Fed's preferred inflation gauge. And then we got a massive drop on the last print that we just got. So as of right now, if we only focus on the year ending in 2025, you can see here again that inflation is in fact trending lower. So what are we going to do next week? Well, let's first go look at the SPX, as I wasn't done over there. I bounce around so much. I'll try to edit the video up a little bit better. But on the S&P 500, we did get the initial move that I wanted to see last week. However, with that bad news on Friday, it bounced back down. We did get a spike up on the VIX. The VIX essentially filled an unfilled gap up here, so that's good. It retreated from the highest daily close that we have right there. So we can drop this down to here. Close enough. So did we close above this point? No, we have not yet, so that's good. As long as we do not close the daily candle back above 2487 on the VIX, I would be a buyer on the S&P. Going back over to the S&P, we have an obvious objective line that we can watch, but another thing we can do is throw on our moving averages here. There is our loss of very bullish momentum for the near term. You can't just go up straight up, just like you don't go down straight down. There's always ebbs and flows in the market. Right now the trend is up. Right now, the momentum is up. You're still above bullish momentum. You're pulling back to and around the 21 exponential. If we pull back to the 200, which is this purple line, you also have April's high and July 2024's high. I would just focus on April's high and the 200 right here. So if we pull back next week, it's going to be a shortened week, I think. If the S&P is open on Monday, then it will not move very much, more than likely. Memorial Day is a huge holiday in this country. It's a very huge holiday in this state. Everybody likes to go out on the ocean and the rivers and the lakes in their boats and have barbecues in remembrance of our fallen soldiers and our loved ones. So Memorial Day, big holiday in the US. So I likely will not get involved with the S&P 500 unless we get a pullback to the 21 or down here to April's high, which is the bottom edge of the expected range. The exact price to watch would be 56.95, but how likely is it going to be that that price holds to an exact tick? It's probably not going to happen that way. But if we build any kind of support in and around this area next week, I will be looking to be a buyer and try to get positioned for a long if it does in fact look like it is trying to build in support. Moving over to Bitcoin. Oh, one last thing before I forget. If we go look at the weekly time frame over here as well, you can see that your weekly 21 exponential moving average is also coming in down here around this area. So you may not come all the way down here. You notice there is a gap from this swing high to up there. That means this candle closed, this candle opened way up there. So gap fill would be right here around 57.20. You will have gap fill. So at that point, if it bounces there, I could be a buyer. But there's just a lot of support, potential support coming in down around the 5,700 down to the 5,670 spot area, or if I can catch a liquidation swing low down there as well. Same thing on Bitcoin, big down day yesterday, making this a potential trap, putting in a supply candle. If you notice, today's price action traded almost right up to that supply and has reversed. You didn't get a perfect tag of that level, but I'm sure people are looking to short that area. So moving on next week, I'm going to be doing the same thing. Here is your weekly range. This is Monday's swing low up to Thursday's swing high. That sets your weekly low to high. Here is your fib range. This is the 50% retracement of that range. I can be a buyer as low as the 786. So I will be watching around the 104 area to look to be a potential buyer for any upside continuation that you may or may not get. But as long as we are above this, as long as we are above the 50, and as long as we're above the yearly opening range, I have to position or look to position myself bullish on any pullback based on any news, because that's generally how you get your pullbacks in a bull market. This is clearly a bull market. You have made fresh all-time highs. If you are still looking for the bear market to continue, I would have to say that I honestly believe that you are positioned on the wrong side of the market. Make sure you guys smash the likes in this video. Make sure you guys subscribe if you haven't already, and I will see you on the next one.